The housing boom is officially over. Welcome to the Property Imperative Weekly to the 7th of April 2018. Hello again. I'm Martin North, the Principal Analyst at Digital Finance Analytics. In this week's digest of finance and property news, we start with Paul Keatings, he of the recession we had to have fame, who commented that the housing boom is really over at a recent AFR conference. He said that the banks were facing tighter controls as a result of the Basel rules on capital adequacy, whilst financial regulators had had a gutful of them. This was likely to lead to changes that would restrict the bank's ability to lend. He cited APRA's recent interventions in the interest-only loans area as one example, as they restrict their growth. And Keating also said that the Royal Commission into Misconduct in the banking and financial services sector would also make life harder for the banks, and pointed out that banks did not really want to lend to businesses these days and would rather just do housing loans. Finally, he spoke of the misincentives within the big banks to grow their businesses by writing new mortgages, including having a high proportion of interest-only lending. Separately, Anna Bligh marked her first year as CEO of the Australian Banking Association, ABA, at the same conference, and said that she felt like 500 years had passed in the last year. Commenting on the Royal Commission, she warned that credit could become tighter ahead. There was, she said, an opportunity for a major reset, not only in how we do banking, but how we think about it, its place in our lives, its role in our economy, and most of all, its trustworthiness. And at the same conference, Rod Sims, the chair of the ACCC speech, Synchronised Swimming versus Competition in Banking, discussed the results of their recent investigations into mortgage pricing and also discussed the broader issues of competition versus financial stability in banking. And he warned that the industry should be aware of and respond to the fact that the drive for consumers to get a better deal out of banking is shared by many beyond the ACCC. Every household in Australia, he said, is watching. And you can watch our separate video blog on this for more details. He specifically called out a lack of vigorous mortgage price competition between the 5 big banks, hence synchronised swimming. Indeed, he says discounting is not synonymous with vigorous price competition. They saw evidence of communications referring to the need to avoid disrupting mutually beneficial pricing outcomes. And he also said that residential mortgages and personal banking more generally make one of the strongest cases for data portability and data access by customers to overcome the inertia of changing lenders. And finally, on competition, he said that if we continue to insulate our major banks from the consequences of their poor decisions, we risk stifling the cultural change that many say is needed within our major banks to put the needs of their customers first. Vigorous competition is a powerful mechanism for driving improved efficiency and also for driving improved price and service offerings to customers. It can in fact lead to better stability outcomes. And this puts the ACCC at odds with APRA, who recently again stated their preference for financial stability over competition. Yet, in fact, these two elements are not necessarily polar opposites. Then there was the report from the good people at UBS that published further analysis of the mortgage market, arguing that the Royal Commission outcomes are likely to drive a further material tightening in mortgage underwriting. And as a result, they think households' borrowing power could drop by around 35%, mainly thanks to changes of analysis of expenses, as the HEM benchmarks, so much criticised in the inquiry, were revised. Their starting point assumes a family of 4 has living expenses equal to the HEM basic benchmark of $32,400 per annum, and that's less than the old age pension. And this is broadly consistent with the major banks' lending practices through 2017. And as a result, the borrowing limits provided by the bank's home loan calculators fell by around 35%. And the loan-to-income ratio fell from 5 to 6 times to 3 to 4 times. And this leads to a reduction in housing credit and further potential falls in home prices. Our latest mortgage stress data, which was picked up by Channel 9 and 2GB, thanks to Ross Greenwood, shows that across Australia, more than 956,000 households are now estimated to be in mortgage stress, compared with 924,500 last month. And this equates now to 30% of households. In addition, more than 21,000 of these are in severe stress, which is no change from last month. We estimate that more than 55,000 households risk 30-day default in the next 12 months, and we expect bank portfolio losses to be around 2.8 basis points, although losses in Western Australia are higher at 4.9 basis points. Flat wages growth, rising living costs, and higher real mortgage rates are all adding to the burden, and this is not sustainable, and we're expecting lending growth to continue to moderate in the months ahead as underwriting standards are tightened and home prices fall further. The latest household debt to income ratio is now sitting at 188.6, which is a record. And you can watch our separate video blog on this important topic. ABS data this week showed that the number of dwellings approved in Australia fell for the 5th straight month in February, in trend terms with a 0.1% decline. Approvals for private sector houses have remained relatively stable at around 10,000 for a number of months, but unit approvals have fallen for 5 months. And overall building activity continues to slow from its record high in 2016. And the sizable fall in the number of apartments and high-density dwellings being approved comes at a time when a near-record volume are currently under construction. And if you assume an 18 to 24-month time frame between approvals and completion, then we still have 150,000 or more units, mainly in the eastern suburban centres, to come on stream, which will put more downward pressure on home prices. And this helps to explain the rise in 100% loans on offer via some developers, plus additional incentives to try to shift already built or under construction property. CoreLogic reported last week's Easter period slowdown saw just 670 homes taken to auction across the combined capital cities, which was down significantly from the previous week, when there was a record number of auctions, around 3,990. The lower volumes last week returned a higher final clearance rate at 64.8% of homes selling, and that's a lift from 62.7% the previous week. Both clearance rates and auction volumes fell across Melbourne last week. Sydney had the highest volume of auctions of all in the capital cities, with 394 held and a clearance rate of 67.9%. Across the smaller capital cities, clearance rates improved week on week in Canberra, Perth and Tasmania. However, volumes were significantly lower across each market last week compared with the week prior. Across the non-capital auction markets, the Geelong region recorded the strongest clearance rate last week. Now, the number of homes scheduled to go to auction this week will be somewhat higher across the combined capital cities, with 1,679 currently being tracked by CoreLogic. And just to update you on my research with regard to auction clearance rates, I hope to be able to publish my blog over the next week on what I found. But finally now, with local news all looking quite negative, let's look across to the USA, as the most powerful banker in the world, JP Morgan CEO Jamie Dimon, just released his annual letter to shareholders. Given his bank's massive size, it earned $24.4 billion on $103.6 billion in revenue last year, and its reach as a giant in consumer, commercial banking, investment banking and wealth management. Dimon has his finger on the financial pulse. And he says that while the US economy seems healthy today, and he's bullish for the next year or so, he admits that the US is facing some serious economic headwinds. For one, he's concerned the unwinding of quantitative easing could have unintended consequences. And remember that QE is just a fancy name for the trillions of dollars that the Federal Reserve conjure out of thin air. He said that since QE has never been done on this scale and we don't completely know the myriad effects it has on asset prices, confidence, capital expenditures and other factors, we cannot possibly know all of the effects of its reversal. We have to deal with the possibility that at one point the Federal Reserve and other central banks may have to take more drastic action than they are currently doing, reacting to the market, not guiding the markets. And of course, the Dow finished the week on a downtrend, down 2.34%, and wiped out all of the gain this year. And volatility is up again. And here is the plot of the Dow. This extreme volatility does suggest that the bull market is nearing its end. That is, if it hasn't already ended. Diamond seems pretty sure we're in for more volatility and high interest rates. One scenario that would require higher rates from the Fed is higher inflation. If growth in America is accelerating, which it seems to be, and any remaining slack in the labour market is disappearing, and wages start to go up, as do commodity prices, then it is not an unreasonable possibility that inflation could go higher than people might expect. And as a result, the Federal Reserve will also need to raise rates faster and higher than people might expect. In this case, markets will get more volatile as all asset prices adjust to a new and maybe not so positive environment. Now, here's the important part. For the past 10 years, the largest buyer of US government debt was the Federal Reserve. But now that QE has ended, the US government just lost its biggest lender. Diamond thinks other major buyers, including foreign central banks, the Chinese, for example, could also reduce their purchase of US government debt. That, coupled with the US government's ongoing trade deficits, which will be funded by issuing debt, could also lead to higher rates. So we could be coming into a situation when the Fed will have to raise rates faster and or sell more securities, which certainly would lead to more uncertainty and market volatility. Whether this would lead to a recession or not, we don't know. And there's one final point from Diamond. He acknowledges markets have a mind of their own, regardless of what the fundamentals may say. And he says that the real risk is that volatility and declining markets could lead to a market panic. Financial markets have a life of their own and are sometimes barely connected to the real economy. Most people don't pay much attention to the financial markets, nor does the market affect them very much. Volatile markets and or declining markets generally have been a reaction to the economic environment. And most of the major downturns in the market since the Great Depression reflect negative future expectations due to a potential or real recession. In almost all of these cases, stock markets fell, credit losses increased, and credit spreads rose, among other disruptions. The biggest negative effect of volatile markets is that can create market panic, which could start to slow the growth of the real economy. Because the experience of 2009 is so recent, there's always a chance that people may overreact. Diamond cautioned investors that interest rates could rise much sooner than they expect if inflation suddenly comes roaring back. Indeed, it's entirely possible that the 10-year rate could break above 4% in the near future as inflation returns to 2% and the Fed shrinks its balance sheet. Diamond also cast a wary eye towards exchange-traded funds, which have seen their popularity multiply since the financial crisis. In fact, there are now more EFT products that are considerably more liquid than their underlying assets. In fact, far more money than before, about 9 trillion of assets, which represents about 30% of total mutual fund long-term assets, is managed passively into index funds or EFTs, both of which are very easy to get out of. Some of these funds provide far more liquidity to the customers than the underlying assets in the fund, and it is reasonable to worry about what would happen if these funds went into large liquidation. And finally, America's net debt currently stands at 77% of GDP. That's quite high, but not unprecedented. And the chart below shows the Congressional Budget Office estimates of the total US debt to GDP, assuming a 2% real GDP growth rate. Hopefully, with the right policies, they can grow faster than 2%, but more debt does seem to be on the cards. And to add to that perspective, we spoke about the recent Brookings report, which highlighted the rise in non-conforming housing debt in the USA, as lending standards are once again being loosened and there are additional risks to mortgage servicers. The authors quote former Ginnie Mae President Ted Tozer concerning the stress between Ginnie Mae and their non-bank counterparties, saying, "Today, almost 2/3 of Ginnie Mae guaranteed securities are insured by independent mortgage banks. And independent mortgage bankers are using some of the most sophisticated financial engineering that this industry has ever seen. We have depended on sheer luck that the economy does not fall into recession and increase mortgage delinquencies. Luck that our independent mortgage bankers remain able to access their lines of credit. And luck that nothing critical falls through the cracks." Now, they say that goldfish have the shortest memory in the animal kingdom, something like 3 seconds. But not even a decade after these loans nearly brought down the entire global economy, subprime is back. In fact, it's one of the fastest growing investments among banks in the US. Over the past 12 months, the subprime volume among US banks doubled, and it's already on pace to double again this year. So what could possibly go wrong? If you found this useful, please like the post and add a comment or a question. If you've already subscribed, many thanks. I appreciate your support. And if you've not done so, then please subscribe now to receive future updates. I'm Martin North, Principal Analyst at Digital Finance Analytics. Many thanks for taking the time to watch.